These documents can be located on the Jamaica Stock Exchange website, and they can also be found on the Investor Relations section of the SYGNUS Group's website, www.sygnusgroup.com. I will now go ahead and introduce our presenters for today's session. We have Chief Investment Officer and Executive Vice President of SYGNUS Capital, Mr. Jason Morris, and Vice President and Head of Real Estate and Project Finance of SYGNUS Capital, Mr. David Cummings. Following the remarks from Jason and David, we will be taking questions. So we are encouraging our attendees to participate in the session today by submitting questions using the Q&A feature within the Teams platform or via email srf@sygnusgroup.com. You may also submit questions on the YouTube platform. Over to you, Jason.
Thank you, Justine. Good morning, everyone. I hope the summer is treating you well and you're not too hot wherever you may be. Jumping right into it. Just want to start off by, again, even though Justine already stated it, just to remind everyone that you should always read interim financial statements in conjunction with the most recent audited financial statements, which contains all the notes to the financial statements and is more fulsome and give you a good appreciation of what the company does if you haven't already done so. That being said, start out as usual by giving some insight into some of the major milestones for SRF during the quarter and over the 9 months period as to what we have been doing. So 4 key items I want to highlight. The first one, which is brand new, is that SRF would have entered into a new joint venture called Delphin Holdings Limited right at the end of the 3rd quarter. And this JV would have involved the acquisition of a 4.9 acre property in Trelawney, where SRF effectively has an 86% ownership stake. And this asset is zoned for residential and / hospitality. And the strategy behind this is really to have another project that will obviously replace assets that are, going to roll off the balance sheet. Of course, we all know that One Belmont is effectively completed, and we are working on the exit strategy for One Belmont. And so once One Belmont kind of roll off the balance sheet, then even if we keep a portion of it for revenue generating purposes, we need to have another asset to replace that, and so forth and so on. And so given where we are in our second investment cycle, that's kind of the ideation behind this new JV. And I'll let David provide additional information, about the location and so forth and so on, or any other insights and thoughts that he wants to provide as the head honcho, all things in real estate. Second item around deployment and exits, we have now moved up to 2.34 billion in new commitments. So as we would have stated last year, this time when we were winding down the first investment life cycle, and we said that deployment would slow down, but as we get into the second investment life cycle, deployment would start to ramp back up. And in conjunction with that, we would have, as we would have stated in many prior quarters, we would have reduced the management fee charged by the manager temporarily for a 2-year period. And this year is the second year of that 2-year period, which ends on August 31st. And then we said that as we get into the second life cycle proper, we would be ramping up deployment, which is what we are reporting here. And at the same time, we're also exiting assets that are on the balance sheet, 2.01 billion so far during the course of this financial year for the 9 months. So we are doing what we said we would do. The other item around dividends is not new, but it happened during the second quarter, so we still should put it up there for those who are participating in this forum earnings call for the first time. Would have paid our first dividend, and the intention is to keep this dividend payment going. In terms of returns, we are now 1.66 times total value to paid in capital. So effectively, we have increased the share capital that investors would have given to us by 1.66 times. And important to note that included in the share capital on a go-forward basis will be the debt for equity swap that would have occurred during the third quarter, where $1 fees that were owed to the manager were converted to equity, and so that now forms part of the equity base. So we are tracking the overall return to all equity shareholders who would have contributed equity capital to the firm. What's the value of that asset, of that share capital? If we were to sell off all the assets on the balance sheet and repay all the debt that SRF owes, what's the value that's left for shareholders? And we are saying that that value is 1.66 times greater than what the initial investment was by those shareholders. And we have a slide that kind of explains a little bit more later on. Now jumping right into the financial performance for the third quarter. First, I'd like to say that this is the second consecutive quarter in a row that SRF has actually made a profit, which is kind of changing the trend a little bit from interim losses on a quarterly basis, kind of reflecting SRF's business model, where we're in the business of unlocking value in real estate by either acquiring real estate and figuring out how to make money from it, and after we have made the money, we exit it and then redeploy that capital, as well as to pay dividends from it, right? But a large part of our holdings are raw land, and some of our holdings are developments which are ongoing. And to that extent, we only value those real estate assets at the end of each financial year. So typically what happens is during the interim financial periods, when the increased value or the value that is being unlocked in a development isn't being measured on an interim basis, we only get that at the end of the financial year. So typically what would happen is we would have kind of negative interim financial reports, and then at the end of the financial year, where when all of the activities that we are doing is reflected, then that's when we see the true underlying performance of the company. So that being said, for the third quarter, the net profit would have been 151.74 million versus 136.02 million loss for the similar period last year, based just due to what I would have just explained. Now, the main driver for the third quarter profitability would be due to the share of gain on the newly formed joint venture, primarily because the acquisition was done at a substantial discount to what the actual market value of the asset is, which is part of what we're in the business of doing. That's part of how you unlock value, by being able to identify and negotiate and get into transactions that gives an upside. And then our job is to unlock that and realize that value on a go-forward basis. Total investment income as a result was 380.54 million versus a loss of 82.43 million for the similar quarter last year. Net investment income 265.29 million versus a loss of 160.66 million for the similar quarter last year. and earnings per share is 44 Jamaican cents versus a loss of negative 42 Jamaican cents for the similar quarter last year. And book value per share was $24.14, up 7.3% versus $22.49 for the similar period last year. And again, just to highlight the point I was making in my explanation earlier, that the total value to paid in capital 1.66 times, and this paid relative to the contributed capital that shareholders would have put into the firm, which also includes the dividends that would have paid back to shareholders. And on an annual basis, looking at the audited financial statements, the most recent audited financial statements, the average ROE and SRF is 19.15%. And again, we'll update this again at the end of the current financial year, August 2025, to see what that number will be. For the 9 months, net profit would be a loss of 45.71 million relative to a loss of 456.15 million for the similar 9-month period last year. And for total investment income, that was positive 407.13 million versus negative 137.74 million for the similar 9-month period last year. So we can see in both instances, the profitability and the top line revenue numbers have improved substantially relative to the similar 9-month period last year. And again, just to highlight the fact that the full year financial last year, despite that 9 months negative of 456, was a positive net profit. So we are in a much better position after the 9-month period this time versus the similar period last year. Net investment income 105.08 million versus negative 388.76 million for the 9-month period last year. And earnings per share negative 14 Jamaican cents versus negative $1.40 for the 9-month period last year. Just want to highlight a couple items for the 9-month period. So from a reporting point of view, right, as you see on the next slide, where we kind of put up the financial statement and break down some of the numbers, there is a 95.48 million gain and acquisition of shares in joint ventures, which is driven. So this is over the 9-month period now. If you recall, we actually would have taken an additional, would have increased our stake in RDA Holdings, I think during Q2 by 16%. And that increased acquisition, increased stake in RDA, which took our position to I think also 86%, would have resulted in a one-time gain and acquisition of those shares, because we would have bought those below their fair value. So we would have gotten a gain there. So that was reported in Q2, and that would have contributed to Q2's net profit figures, and obviously contribute to the net profit figure during over the 9-month period. And then on the joint venture, gain of share of joint venture, we would get two benefits, right? Remember that RDA Holdings is actually a joint venture, and we would have increased our stake in RDA, and therefore, from a joint venture perspective, if the joint venture is making a gain and we have a higher stake because we increase our stake by 16%, then it means that we would get a bigger gain on joint venture when we are looking at RDA Holdings Limited over the 9-month period. And then we also just did the Delphin Holdings joint venture, which we already said that we have a gain on that joint venture because we would have the acquisition would have been done below the fair value of the asset, and therefore we have two gain on joint venture that result in the figure that you are seeing. 583.11. So if we move to the next slide, this will become a little bit clearer. So on this slide, just want to highlight a number of things. If you look at it, net interest income line, where you have interest expense, where you have interest income 50.16 million for the quarter versus 45.9 for the 3 months, and then for the 9 months we have 157.6 versus 134. So you can see that from a quarterly perspective, interest income is gradually increasing, but it's not increasing fast enough because it takes time for us to deploy capital into, for example, new REINs that we added on the balance sheet, right? That's a timing issue. But we would have funded some of these transactions with additional debt, and we are basically generating the interest expense on all of the debt that we use to fund the transaction. So we need some time to pass to fully deploy all of the capital into the interest-bearing asset, into the income-generating asset for the interest income to fully ramp up. And that's the reason why net interest income is still negative, both for the 3-month period and for the 9-month period. Other item I want to highlight here is gain and acquisition of shares of 66.7 million for the 3 months versus 95 million for the 9 months. So it's that 9-month figure is positive, but the quarterly figure is negative. And that's because we would have had gain, one-off gain on the acquisition of shares when we increased our investment in One Belmont, but we have what is accounted for as a quote-unquote loss and of 66.71 million, which actually comes out of the Delphin transaction. But effectively, this is accounted for as a loss. Basically, the reason why this is accounted for a loss is because in the Delphin transaction, our 86% stake, we had to pay a one-off premium, and that one-off premium is accounted for under loss of acquisition and shares. But on the same Delphin transaction, we have a gain on the joint venture that's substantially bigger than the 66.7 million one-off loss and acquisition of shares. So on a net basis, our overall gain on Delphin is 500 million plus. But it's just how we have to account for the different parts of the transaction. So I just want to actually highlight that for the quarterly results, while for the 9-month results you see where we have overall gain and acquisition because we have 2 transactions, one with a positive offsetting the one with the negative. Other item I want to highlight here is the fact that from a foreign exchange position, we're showing a net foreign exchange loss of 58.1 million for the quarter, and for the 9 months is 42.5 million. And the reason why the 9 month is a lower loss than the quarter is because on the acquisition of the Delphin transaction, we would have used a combination of Jamaican dollars and US dollars. And for a portion of the Jamaican dollars, obviously we have to convert that to US. And that conversion would have resulted in some one-off foreign exchange translation loss to do the acquisition, as well as the fact that the exchange rate depreciated and we have a higher stock of US dollar liabilities on our balance sheet, which suffer from the movement in the exchange rate. Of course, the key point here is that for SRF, which is not, it's not a foreign exchange business. However, from the perspective of the real estate assets on the balance sheet, which about 73% or so of the real estate assets on the balance sheet are actually denominated in United States dollars, right? But for accounting purposes, real estate assets are not financial instruments, and therefore, because we don't value these assets on a quarterly basis, one, and even when we value them at the end of the financial year, the foreign exchange component is not broken out. So at the end of the financial year, when we revalue those assets, part of the change in the value of the assets will be due to movement in the exchange rate, because we have a US dollar real estate asset on the balance sheet and we're doing the valuation, but SRF is reporting in Jamaican dollars, then obviously the valuation will go up if the exchange rate moves, right? However, that change in value is not broken out as a foreign exchange component. So I'm saying all of that to say, when we see net foreign exchange loss in the interim and even in the year-end financials, we have to take into consideration that we have substantially more assets on the balance sheet than the liabilities that are denominated in US dollars. But the gain reported on that asset isn't broken out. So on a net basis, we're pretty much, I would say, cover the foreign exchange loss that you see on the balance sheet by some margin, but you don't see it reported as a line item. So we are getting back the value, but we're not getting back the value in the same line item. I hope I haven't confused everyone, and everyone is kind of clear as to what I'm saying. All right, so we can move quickly through the rest of the presentation. Balance sheet, shareholders' equity 8.38 billion, up 14.1% versus 7.34 billion for the similar period last time, and total assets is now 16.06 billion, up 9.7% versus 14.64 billion last time. And I mentioned before that from a return multiple or performance, another way to look at performance of SRF is that shareholders would have paid in 5.1 billion Jamaican dollars, and at 5.1 billion, the value of that to shareholders is now 8.45 billion. And this 8.45 billion includes the dividend that would have been paid to shareholders in December of last year. And I also highlighted the fact that the conversion of the 377.91 million debt that was converted to equity during Q2 is included in this calculation. Looking at efficiency, how we run the business, we have a target 3.5% management expense ratio, which is saying for every dollar of revenue that is generated, we should not spend more than 3.5% of that on expenses. And you can see that we are well within that threshold, coming in at 2.5%. Taking a quick look at investment activity. At the end of Q3, we had 15.7 billion in real estate investment assets versus 13.69 million for the similar period last year. And this was comprised of 9.62 billion in property investments, which is down from 10.32 billion the similar period last year. And that's because we would have exited a number of transactions over the 9-month period. That's the reason why that figure is down. In terms of real estate investment notes, which are the income generating assets on the balance sheet, these are now 2.24 billion, up from 1.84 billion, a similar period last year, again reflecting the fact that we are deploying more capital into income generating assets. And then from joint ventures, this is now up to 3.84 billion, up from 1.53 billion, so more than double. And that's because of the new JV that would have entered. And then exits 2.01 billion, up from 1.09 billion at the same period last year. From a allocation perspective, you can see that SRF is very diversified across all the multiple real estate categories. And from a allocation by investment category, we still have a large proportion in investment property at 56.3%, but this is down from around 75 or so percent more than a year ago, and down from about 80% maybe 2 or so years ago. Now, I'd like to move into the section dealing with major projects. And the first slide is looking at a summary of key strategic assets that we have on the balance sheet. And you can see the new holding there, Newcourt Trelawney Delphine Holdings, or the 4.9 acres representing 86% of that joint venture. That is the new asset on the balance sheet. All the others have been existing for quite a while, and I'll invite David to give some additional insight on the assets that we currently have on the balance sheet. David?
Thanks, Jason, and good morning, everyone. First up on screen, you can see is our One Belmont property, which is, of course, our flagship Class A mid-rise tower. And as Jason indicated, we're pretty much complete here with the second tenant preparing to move in over the summer here in the coming weeks. So we're certainly, and if you drive past on Belmont Road here now, you'll see one of the last visible things that we were put in place, which is the fountain. You'll see water sprouting from the fountain as you drive past. The sort of the last visual piece that you will notice of the building from the exterior. So the bottom line is that the One Belmont Class A building is complete, and the tenants are in the midst of either moving in or completing their interior designs. Next slide. Miami Bay, which is our 14-acre beachfront property, and I'm happy to report that we're making great progress towards in our discussions with potential partners, and of course we've made very positive advances towards the decision phase of this particular project. So clearly, in the coming months ahead, as we get into that phase, we will be reporting back to investors and shareholders the clear direction for the Miami Bay project. Next slide is the Lake Spen Holdings, which is our 55-acre industrial park out in the Lake Spen area of St. Catherine, diagonally opposite where Wysinco's plant is, and astride the east-west highway. We, as indicated on the slide, we have entered into a design build contract with a contractor. That contract was executed. We are pretty much at the back end of the design phase, and we are on track, or we remain on track for construction to commence in early 2026, as indicated there. So again, great progress with respect to our industrial property. Delphine Holdings, again, Jason alluded to this. This is in Trelawney, in an area called Newcourt. And as we speak, we are in the process of considering a couple of potential design concepts for this particular property. But of course, we're going to make sure that we find the best way to unlock the optimal value for this particular property here, which is new onto our balance sheet. And the last one. So with that, I say thank you very much, and I'll hand back to Jason to conclude.
Thanks very much, David. So as you can see, we have quite a range of assets that we are looking at on the balance sheet, ranging from commercial, residential, industrial, and hospitality. So we are well diversified and looking to just continue to unlock value. In terms of our strategic initiatives, not much has changed from last quarter. We are just in execution and drive mode. So One Belmont, David already gave the update on that. The key thing here is the structuring of the exit, and we are working feverishly on that. And when we have more information on what that is, we will bring that to shareholders. Safe to say that the structure that we are working on will avail shareholders the opportunity to participate in the ownership of that. Miami Bay, Lake Spen, that just continue in the value creation process. Deepening access to flexible capital, which involves co-developments and joint ventures. And as you can see, Delphin Holdings, which is the newest asset on the balance sheet, is one such asset, and we have others that we are considering. Portfolio realignment. We would have done a lot of realignment of the portfolio, because we would have sold off some assets from the balance sheet where we got a good offer for them, and have basically reutilize and redeploy that money into REITs as well as into the newest JV that we have on the balance sheet. And the key here is to ensure that as we are rolling off assets off the balance sheet, we have replacement assets for them, so that we can repeat the process of the success of the assets that would have successfully executed on the balance sheet already. Investment cycle overlap. Spoke about that earlier, so I don't need to highlight this again. And of course, asset workouts. We have 2 third-party REITs that are still in workout. One of them, we have kind of almost at the back end of it, in terms of would have worked on that feverishly, get it to a very good stage, and have that asset exiting as we speak. So that's a good outcome. And the other one, we still have to work through all the issues that are involved with that asset, so that we can get a recovery of our monies. Of course, we have the underlying asset as collateral, so we take our time to ensure that we get the best value for our shareholders. Second item is in terms of expanding footprint in other Caribbean countries. I know that David and team have been looking at quite a number of transactions in multiple Caribbean markets. Maybe I should let you take a stab at this, David, if you have any comments.
Sure. Thanks, Jason. I think the main takeaway here is that there is plenty of opportunity across the region. We have been taking a close look. Clearly, there are some nuances with each particular territory that we're being mindful of, but the good news is that we are seeing that there are some really great opportunities, across the basin, stretching from Belize, Cayman, Turks and Caicos, Bahamas, Guyana, and Barbados, St. Lucia, just to name a few. And these opportunities are mainly in the residential, hospitality, and commercial sectors. But the good news is that we are taking our time to understand the territory, taking our time to understand the local regulations, understand the local players, professionals, contractors, what is the absorptive capacity in each of these territories, so that when we do make the submission through our governance process here for our investment committees, REAC, and so on, for investment approval, we will do so having done a good assessment of the risks involved in investing outside of Jamaica. But the good news is that we're seeing a very healthy pipeline of projects coming to us, and we are taking our time to ensure that we do our due diligence on each and every one of them as they come to us.
Thank you very much, David. And again, it's the same kind of model where we will look to do partnerships in many instances, so that we get the best opportunity to unlock the value. So we'll speak more about that when we have the first such opportunity that we feel a compelling value that we can make that first foray outside of Jamaica in a deliberate way. Dry powder, just keep harvesting and redeploying capital. So basically recycling capital. So we continue to do that. And in terms of capital, new capital, we're looking to expand our credit lines. And of course, where we have certain individual projects that need individual financing, we seek private investors for individual projects, which is what we have been doing and which is what we will continue to do as we go through time. Whenever those projects get to this stage, we are ready to execute. And dividends, spoke about the first dividends, and of course, looking forward to the second dividends at the appropriate time. That's the end of the presentation. Thank you very much. We'll take any questions that you may have.
Thank you for the detailed presentation, Jason and David. Not just highlighting the performance of SR, but an asset by asset update is what we got today. So at this time, we're going to move into the Q&A segment of the session. And a reminder that your questions can be submitted using the Q&A feature of the Teams platform, as well as on YouTube or via email, srf@sygnusgroup.com. So we have a few questions. So I am seeing some on YouTube. I'll start with the ones via email. Are there any, the first question is in relation to the Delphin Holdings joint venture. Are there any predetermined plans for this joint venture?
So, excellent question. Thank you very much. Predetermined plans. Let me phrase it this way. I believe that before we do any sort of investment to acquire the property, we undertake quite a significant amount of due diligence and research, understanding the location of the property, understanding the market dynamics, and not just the market dynamics today, but forecasting what the market dynamics will be in 2 to 3 years when this product comes to market. So yes, we have a fair idea of what concepts are likely to give us the sort of investment yield that we are seeking for this particular property. And when I gave my brief remarks, I did indicate that we have 2 particular concepts that we are currently working through. Obviously, we have to model it and do various market analysis and so on. So yes, we do have concepts in mind when we make these investments. But of course, there are many components that we must take on, understanding, from a regulatory standpoint, just ensure that we'll be allowed to build what we have conceptualized, understanding from a financial standpoint, will it deliver the returns that investors are seeking, and so on. So in short answer, yes, we do have concepts in mind when we make these investments in this particular property and all of them.
Thank you, David. Go ahead, Jason.
And just to add to what David is saying, if you recall on several occasions when we give our outlook on the various sectors, right? We're always, I would say, super bullish on industrial as well as anything that is close to water. We have a very, very favorable view of those 2 sub-segments of real estate. And so to add to what David is saying, we have a pretty good idea of what we want to do, but of course you can't do most of that work without having the asset under your wing. So now that we have the asset under our wing, we are going through the process. But yes, we have predetermined pretty much what we want to do. It's just the nitty-gritty that we are going through.
Thanks, Jason. All right, so we have a question online on YouTube. There is seemingly a real estate bubble emerging in Jamaica, especially at the high end. How will this be ring-fenced again in the case of SRF?
You want me to take a stab at David, or you want to go?
I'll start in saying the question of a bubble in the industry has been raised several times over the last 12 months. But I think it's a very broad statement, and it needs the segment. The industry itself is segmented. And I was speaking about the residential segment here, in that there is a high end, a middle end, and a low end. You have to consider the location is one thing, because clearly, whereas the Kingston market may be under a bit of pressure from a supply side, but the same segment of the market is doing well in other parts of the island, particularly on the north coast. At the lower end of the scale, on the low income side, pretty much I think we all know that we Jamaica just cannot build enough low income houses to satisfy the significant demand that we have pretty much in every single parish. So the word bubble is something that I think I would be guarded in using the word bubble, because you have to also consider, if a bubble bursts, what are the consequences? Are you going to see prices of falling? And I think we all are sufficiently schooled to know that what we might see is a leveling off of prices as opposed to a crash or a fall. So I would not use the word bubble. I've never used the word bubble myself. Just that you have to be aware of the sub segments in each sector and do the analysis data driven to tell you about what is your best investment decision. And because all of what we do here at SYGNUS Real Estate Finance is data driven, is scientifically driven, and not just anecdotal, not just what others may say or feel. We take the time and energy to do our own research. And many instances you may see us making moves that you question. For example, I'll give you a perfect example of One Belmont. When we started to design One Belmont, we were told we were crazy, because at the time we were in COVID, and we're told that the future is work from home. So why are we building a 9-story tower, office tower, and the future is work from home? That we were crazy. But we had done our homework, and we knew exactly who our tenants were, and after we built Belmont, there's been 12 or 13 other commercial buildings that came after, because clearly, so what I'm saying is, I would not use the word bubble. I'd be guarded against using that particular phrase. What I would say is, for each investment, take the time and let it be data driven. Let your decisions be data driven. Understand the market, do your research, follow the numbers, and understand where the industry is trending towards. Inform the investment decision.
Yeah. So to add to what David just said, right? And I know that I guess the average Jamaican will, in their mind, be saying, well, if prices are softening, then quote unquote, as the question was posed, bubble. So I mean, I think that there are pockets of the market that is oversupplied, as David said, and obviously because of excess inventory. But if you look at what Delphin is, it's 4.9 acres, and it has a very excellent location in terms of, I think, 18 minutes outside of Montego Bay, which we all know is the tourism capital of Jamaica, right? 18 minutes from the airport, and it has beautiful water to look at, right? And we would have, in many other calls, stated that there are two sides to real estate once you're looking at water. There are the consumers who reside in Jamaica, and you have the consumers who are Jamaicans, but they don't reside in Jamaica, right? And consumers who are maybe non-Jamaican, looking for Jamaican exposure. And the way we look at this is, okay, even if the market is in a soft spot now, or some segments of the market in a soft spot now, what will the market be 2-3 years from now, right? Because that's what if we acquire in Delphin, where the market is today has no bearing on that, right? It's where will the market be when we want to exit Delphin? That's the question. And so, from the perspective of Jamaica's debt to GDP trending about to trend into the 60% plus debt to GDP, which is, when you look across the globe of rated sovereigns, that's pretty much an investment grade type debt to GDP ratio you're looking at, right? And if I look at Jamaica's, where do I expect inflation to be over the next 2-3 years, and therefore interest rates? I think that both things, well, inflation already on a downward trajectory. I think the latest report, we are below 4% now, right? Of course, inflation can go up and down, obviously. But from an interest rate perspective, I think interest rates are still too high. And those high interest rates over the last, I would say, 24 months would have had an impact on some of the softening that we are seeing in the real estate market in terms of perhaps affordability. But when I look at what, where we are heading and where Jamaica's debt trajectory is, and therefore the long run sustainable cost of financing in the Jamaican market, I'm not worried about acquiring an asset that is 18 minutes outside of Mobay and that I can see beach and water. So from that perspective, if you ask how we insulate against the softness with Delphin, it's insulated because of its proximity to the tourism capital of Jamaica. That's the first. Second, it's a small 4.9 acres, but big enough to do a decent, for us to generate a decent return on our investment, depending on what we decide to do with the asset, based just on its location and proximity to the airport and Mobay, as well as to water and sand. And so from that perspective, we think that we will have no problem whatsoever in monetizing this asset appropriately. So that's how we think about insulating it from any softness that we are seeing in some pockets of the real estate market. No. And thirdly, we think in 2-3 years' time, whatever softness we are seeing now will be a thing of the past.
Thank you, Jason, for that. So another question, with the impending elections, do we anticipate any political risk for SRF?
No, I mean, it doesn't matter who is in power, right? SRF has 16 billion in assets on its balance sheet, which is 100 million US effectively. And we are executing according to a well thought out strategy. And frankly, again, based on where Jamaica is today, in terms, again, the key metric is what's our debt to GDP. We are entering in the 60s, which I said is, if you look at some of our social indicators and where those are headed, once we keep those social indicators on our wraps, then it doesn't matter to us. Elections won't bear, it doesn't matter to us, what the election, whether there's an election near term or what the election result is. The key thing is we have very good macro fundamentals, and once inflation remains well behaved, which we think it will, and interest rates trend down to what I'm gonna call steady state, because we think that they are still too high at the moment, then the real estate market will regain some momentum. And so from time to time, markets go through cycles, right? And everything don't go up forever. You have some up down. But the key thing is, what is the trend? And from our point of view, the trend is up, because with a debt to GDP ratio of 60% and a BB rating currently, which we think over the next couple of years, we will be on our way to investment grade, then are very close to it, then we think that creates an environment for real estate assets in Jamaica to reprice upwards. Because if you compare Jamaica's real estate price from a price per square foot perspective of any building that you see, whether commercial, resident, etc., we are cheap relative to the rest of some of the other major Caribbean territories. If you were to look at Bahamas, Barbados, etc., and look at the price per square foot there and compare our price per square foot for anything, we are cheap, right? Of course, we wouldn't have had the economy to kind of rival those countries, but now our big macro fundamentals are there, and now what we need to do is to get at the micro to get there as well, in terms of having enough businesses and economic activity to grow the economy above 5% per annum for the next decade or so. Of course, we are a ways from there, and there are certain things that we have to do. But we think that 2 to 3 years from now, this softness that we are seeing in certain pockets of the real estate, the oversupply, overhang in some sectors, some sub-segments will go away, and we'll be in a good place. So that's how we look. That's how I'm looking at the market. You have to be very strategic and not be reactive to short-term trends, but rather look to what the long-term trajectory is.
Thanks, Jason. So we have a question in relation to governance. At a high level, what governance framework does the SRF have in place for property acquisitions? For example, is there a percentage of portfolio that must be earning an income? Are there approved jurisdictions outside of Jamaica? And are there any concentration limits? Those are some examples that were shared.
Exceptionally good question, right? Brilliant question. So from a governance perspective, in terms of decision rights, SRF has an investment and risk management committee that is chaired by an independent chairman, and the majority members are independent. That's the first thing, right? So in terms of the parameters of how we make selection, ultimately SRF has a 60-40 target, long-term target ratio between income generating assets and equity. Where we are now, we are above that threshold because our strategy has been to first either enter into partnerships where we see that those partnerships provide an opportunity for us to partner and execute effectively, or we go and buy assets individually ourselves and then unlock the value and then wind off that asset off the balance sheet. So we are just starting the second investment life cycle. So we are on track to move towards that kind of 60% of income generating assets to 40% equity. We do have multiple limits. So we have concentration limits per different industry, sub-segments within real estate. So it can't be, say, more than 40% to industrial, more than 55% to residential, etc. So we have each of the sub-segments: hospitality, residential, commercial, etc., that we have limits on. We don't have any country concentration limits per se, which is why we have 100% in Jamaica. We are more opportunistic where countries are concerned. So we made a deliberate action to put all our eggs in the Jamaican basket simply because of what I mentioned in my previous comment, which is Jamaica is far cheaper on a price per square foot basis than many of the other major Caribbean territories. And we expect that Jamaica will reprice upwards, which is why we would have done what we done. Plus, the availability of good location assets are more plentiful in Jamaica than in many other regions. And so that's why we started out with Jamaica. And the strategy that we have to go to other regions is, well, we need to have strategic partners with boots on the ground, and then we more than likely will be executing those via partnerships, such as JVs or whatever else, right? Obviously, because we don't want to be spending too much capital in terms of acquiring land ourselves. But we do have, multiple limits and even counterparty limits, for example, with financial institutions, how much of our cash that we can hold in any one institution. So SRF doesn't operate any differently than any, financial institution that exists from the perspective of managing risk. We have a risk committee that meets every single month. We look at the assets on the balance sheet, we look at the liabilities, we look at the assets that we have in workouts, how are we mitigating the risk. We have quarterly enterprise risk committee meetings at the board level that also look at the various limits that we have. Are we in breach of any of them, etc., etc. So I just want to highlight that from a governance perspective, we are, I would say, we are operating at best practice and international best practice, and SYGNUS as a fund manager actually designed its alternative investment platform as around, for example, related party transactions, counterparty limits, etc., which are permeated across all the investment companies that we manage on the platform, which includes SRF. So all the companies pretty much have the same governance framework in terms of independence of decision making, and then various limits depending on which fund, and SRF as a real estate investment company have all of the appropriate real estate investment limits, and these are reviewed in monthly risk meetings, quarterly risk meetings, quarterly board meetings, quarterly board subcommittee meetings. As you all know, the auditor is KPMG, and we have our annual audits, etc. So from a governance perspective, SRF is, I would say, one of the best in class companies operating to ensure that shareholder, as a fiduciary, shareholder interests are always protected. I hope I've answered the question, although I would have added stuff that wasn't asked in the question just to provide some clarity. But if I haven't, you can ask additional follow-ups. I love these type of questions to showcase the governance structure that we have at SYGNUS.
Thank you, Jason. So the next question is in relation to Storylat Sugar Mill. I'm seeing units for sale in relation to this development. Is SRF to be paid out from these sales?
Absolutely, yes. Short and spicy answer.
All right, thanks, Jason. Another question, are there any more acquisitions planned before the year end?
No, because the year end is a month plus away. There are no more acquisitions that are planned for the year end.
All right, thank you, Jason. And this next question, and the final one that we'll take for today, is in relation to Lakespen. Can we get an update on how the Lakespen project is going? Is it within the timeline that was shared? And when can we expect to break ground?
Yes, thanks for the question. So the project is going as we had indicated, the timeline being, we have already executed the contract. The design, we're at the back end of the design process. So clearly, our timeline is consistent with what we had indicated prior. The estimation is that we should be breaking ground to start construction early in the new year, 2026, which again is consistent with our earlier forecast. So an overall assessment will be that yes, the Lakespen project is on track. Designs are far advanced. Clearly, we'll go through approvals, and the contract for the execution of the works has already been signed. So we are anticipating that we will be able to deliver on the forecast of groundbreaking early in 2026.
Thank you so much for that, David. So we are now at the end of our earnings call session. Again, We want to extend a huge thank you to everyone who attended the session today. As a reminder, we are encouraging you to read the published quarterly results alongside the audited financial statements for the year ended August 2024 and the management discussion and analysis. Apologies. These documents can be located on the Jamaica Stock Exchange website as well as the investor relations section of the SYGNUS Group website. That's www.sygnusgroup.com. As usual, a recording of this earnings call will be available on our website, and a copy of the presentation will be made available later today. Thank you for joining and enjoy the rest of your day.